Hello and welcome to Enrich Academy. This video is on the basics of candlestick pattern analysis. Now if you are new to trading and candlestick patterns, this video will surely help you because I'll walk you through step by step on these patterns, and I'm sure by the time you've watched all our videos, you will be able to understand what these patterns are and why they are important in trading. So let me give you a quick idea of where it started, just a brief outlook, and then we'll dive right into the topic. So the candlestick pattern started 300 to 400 years back by rice farmers from Japan. It started off as black and white candles. Later, Steve Neeson from the US used it to understand the US stocks. He also changed the colors from black and white to red and green. Now these patterns have become quite popular with the traders in the last 10 to 20 years. So it's crucial to understand these patterns before you start trading. So why do we need candlestick patterns? Now candlestick is a pictorial representation of the price movement in the market. It's basically a communication tool for the market. Market cannot communicate with you face to face, right? So the candlesticks help you to understand the language of the market. You can compare it with social media chats like the smileys. Candlestick tells you the story behind the market. Every candlestick tells you a story about the market trend, if the buyers are strong or the sellers are strong. It can also be compared to the game of chess. Every piece has a different role to play, right? Like the queen, king, pawns, bishops, right? Similarly, every candlestick pattern reveals a different sentiment about the market. There are different styles in a chart, like line chart, bar chart, candles, and so on. If you take a look at this charting platform, this is the Market Watch page of Enrich Web Hunt, the trading platform. You can see here various styles. For example, let's take a line chart. Days are plotted on the x-axis and price on the y-axis. Now imagine the price on day 1 is 10 rupees, day 2 is 12, day 3 is 15, day 4 11, and day 5 it's 15. And let's connect the dots. Now here we have a line chart, right? But what is the drawback here? In this chart, these points only reveal to us the closing price. The opening price, the highest price, and the lowest price cannot be seen in a line chart. For this, you will require a candlestick pattern. So what is a candlestick pattern? As you can see here, candlesticks are basically formed of two colors, green and red. Some charting platforms still follow the traditional black and white color. Now when you see a green candle, it means the prices have closed higher for that session. These sticks are called the wicks or the shadow. This is the high of a trading session and this is the low of a trading session. In the red candle, it's just the opposite. The market session opens at the top of the candle and closes at the bottom. So the green candles are called bullish, representing the buyers, and the red candles are called bearish, representing the sellers. So basically there are two main parts for the candlestick, the body and the shadow or the wick. The first pic you see here shows that the body is quite large, showing that the buyers have been pretty strong. So the body tells you who's in control. Now the wick tells you there has been a price rejection. So when you spot a small wick or a shadow, it shows there has been a weak price rejection. And the price closed here at this point. So it's important to understand the size of the body compared to the shadow. Now in the second candle, we can see that the body is quite small compared to the shadow and the prices have gone really high. But there has been a strong price rejection and it closed at this point over here. So this shows us that the buyers are still in control as it's a green bullish candle, but the sellers put up a strong fight and rejected the price all the way down and it closed at this point here, right? So it's still a bullish candle, but the buyers are weak here compared to the first candle. So the point to note is, pay attention to the body of the candle, second, to the shadow or wick of the candle, and third, the size of the body compared to the shadow or the wick. It's also important to understand how the time frame works in the candlestick patterns. Have a look at the Market Watch page here. These are the different time frames. You can choose 5 minutes, 10 minutes, 1 day, 1 week, or a month, and so on. For example, if you choose 1 month time frame, let's take the month of June. The opening price is the price on 1st June, and the closing price would be the price on the 30th of June. All right? Likewise, for other time frames, if you choose 1 hour time frame, every candle represents the time after 1 hour. It means the high after 1 hour trading session. Now sometimes looking at just one time frame may be confusing. If you feel you don't understand the trend in a particular time frame, always move up the time. So if you're looking at 15 minutes time frame, move up to 30 minutes. If you're looking at 30 minutes, move up to 1 hour. Okay? But now that you have a basic idea of what a candlestick is and why it's important, let's look at a few types of candlesticks. The first type is a doji. Doji is very simple to spot on a chart. When you see a candle that looks like a cross or a plus symbol, that's called a doji. Now the doji does not actually have a body because the opening price and the closing price of a doji is almost the same. This shows an indecisive market condition. There are no winners here. It's actually a tug of war between the buyers and the sellers. Both have tried their best to push the prices up and down. So when you spot a doji, you know there's a trend reversal coming up, right? In a doji, you can see that the shadow or the wick is pretty long. This is the highest price and this is the lowest price. And you see there's a very small difference between the opening price and the closing price. The next candle is called a Dragonfly doji. It also has no defined body. It has a long shadow that goes down, and it can be spotted after a downtrend. What this shows is that the bears have tried their best to push the prices down, but the bulls have come back and are trying to reverse the trend back up. Now to remember the Dragonfly doji, you can think of the dragonfly that flies high. When you spot this candle, remember the market is on its way up. The third candle here is a Gravestone doji. It's just the opposite of the Dragonfly doji. The name gives you a negative indication, right? And it indicates that the market is going down. Gravestone also has no body. It has a long shadow that goes all the way down, indicating the rejection of higher prices. This candlestick can be seen after an uptrend and shows a bearish reversal, meaning the market prices are falling. Now both the Dragonfly and the Gravestone doji show a sign of price rejection in the market. Rejection of lower prices and rejection of higher prices. So I hope that this video has given you a clear idea of the importance of candlestick patterns and the 3 different candlestick types. Keep watching our channel to know more about other candlestick patterns. If you found this video useful, please do like, share and subscribe. Thank you.